Hi, my name is Tana Gilday, and I am a principal with Homrick Berg. I'm a financial advisor who works with a lot of women who have gone through the divorce process or the loss of a spouse or the breakup of a long-term relationship and are finding themselves moving forward as a single person. I know that that can be a difficult and overwhelming process as you move from shared journey to navigating things by yourself. And so I created this series of videos to try to provide some helpful information and tips to assist you as you navigate through this journey. This is part of a series called A Great Question Can Make All the Difference. So today's question that I want to discuss is, do I have to pay income taxes if I sell my house? And the answer to that is, it depends. All these financial questions tend to be, it depends. So let's talk about taxes in general. For a house is, from the tax code perspective, considered an investment. And when you look at how are investments taxed, you look at how much did I pay when I bought the investment and how much did I get when I sold the investment. And that difference, if it's greater, is a gain. If it's less, it's a loss. But assuming you have a gain, then that gain may be taxable, or a portion of that gain may be taxable. But let's back up further to say, how do we identify what we paid for it? Because it's not just the original cost when we bought that investment, in this case, your house, your primary residence that you live in. The cost that you paid for it the day you bought it is part of the basis, the tax basis of the asset. But you can also add significant improvements and renovations that you did to the property over time. So you'll want to do a little research or talk to your tax accountant to see which types of things add to that basis. But in general, if it is a substantial improvement to the property that improves the value, then that's going to be added to the basis of the property. So things like renovating your kitchen, finishing your basement, adding a screened-in porch, putting in a swimming pool. Those are big things that improve the overall value of the property. So the cost of all of those things would get added on to your basis that is used for calculating whether you have a gain or loss. So once you identified all of those things, added them up, and remember, things like general repairs and maintenance don't count. So things like painting the rooms or fixing a broken window, those types of things are just general repair and maintenance. And so those would not be considered to add to the basis of the property. Again, there's lots of information on the website, or your CPA can help you. If you have a list of all the things that you've done to the property, they can assist with determining if that's part of the basis or not. But once you add up all of those things and you get to the number, it was $400,000. Great, that's how much your basis is in the property. If you sell it for $700,000, then that difference, the $300,000, is potentially a taxable gain on the sale of the property. The tax code does provide an exclusion for each person of $250,000 of gain if you meet the rules within the tax code. Basically, you have to have used the property, lived in the property as your primary residence for 2 of the last 5 years. They don't have to necessarily be sequential. Again, there's ifs, ands, and buts within the tax code you want to discuss with your CPA. But generally speaking, if you lived in that house for 5 years, then you're going to be able to exclude $250,000 of gain per person. That means if you are filing jointly tax return, you own the house with the spouse or partner, you file together, then you each would be able to exclude that $250,000 of gain for a total of $500,000. If the house is only in your name, perhaps as part of the divorce settlement, you got the house yourself, you're living in it on your own for several years, then your gain as a single person would be $250,000. So as long as the gain is less than $250,000, you would be able to exclude all of that gain. If it was more than $250,000, in our example of having a basis of $400,000 and selling for $700,000, we had a $300,000 potential gain there. If you're single, you could exclude $250,000, and the taxable gain for income tax purposes would be $50,000. So hopefully that's helpful as you think through the tax implications of selling a house. Definitely review your facts and circumstances with a tax professional who can help you put pen to paper and really understand what your numbers are, what your situation is, and if a tax would be applicable or owed if you did sell your house. So I hope you find that helpful, getting a little insight as you navigate this journey as a single person moving forward. As you consider your situation, if you think a financial advisor would be helpful for you, I encourage you to review our website at homrichberg.com. You can see the types of clients we work with, how we serve those clients, and determine if we may be a good fit for you. I'd be happy to chat with you if you think that we are a good fit and you would like to be matched with a financial advisor. Please reach out. I'm happy to assist with that, determine if that's a good fit, and help answer any questions that you might have. As you move forward, I wish the very best to you in your financial journey moving forward. Take care and all the best.